Your retirement account is about to become a government ATM, and you have exactly 18 months to do something about it. In 2027, the financial rules you've trusted your entire life will be rewritten overnight, and most people will lose 30% of their wealth before they even realize what happened. This isn't a prediction. It's already in motion, and by the end of this video, you'll know exactly what's coming and the 3 moves you need to make right now to protect everything you've built. Meet Lisa Chun. She's 52 years old, works as a hospital administrator in Phoenix, and has done everything right with her money. For 28 years, she maxed out her 401k contributions. She built an emergency fund, paid off her mortgage, and avoided credit card debt like it was poison. On paper, Lisa has achieved the American dream. She has $900,000 in retirement savings and plans to retire at 65 with enough money to travel, spend time with her grandchildren, and finally write that novel she's been thinking about since college. But Lisa doesn't know that in 18 months, the government will change the rules so dramatically that her retirement plan will collapse like a house of cards in a windstorm. Here's what happens to Lisa in early 2027, and here's why it should terrify you. Congress passes what they call the Retirement Security Enhancement Act. The name sounds reassuring, almost boring, which is exactly the point. Buried in 300 pages of legislative language are provisions that fundamentally restructure how retirement accounts work. The required minimum distribution age drops from 73 to 65, forcing Lisa to start withdrawing money earlier than planned and pushing her into a higher tax bracket at exactly the wrong time. The annual contribution limit gets cut in half, supposedly to ensure fairness across income levels. Estate tax exemptions shrink from $13 million to $3 million, suddenly making Lisa's modest wealth subject to taxes she never anticipated. And here's the killer. Capital gains rates on retirement account withdrawals increase by 8 percentage points for anyone earning over $75,000 annually, which Lisa will be once she starts those forced distributions. Each change individually seems almost reasonable when politicians explain it on cable news. But together, these modifications will reduce Lisa's actual retirement income by $280,000 over her lifetime. That European trip she dreamed about? Gone. The ability to help her daughter with a house down payment? Impossible. The financial cushion that would let her handle a medical emergency without panic? Evaporated. And the cruelest part? Lisa won't fully understand what happened until years after it's too late to adapt. Now, you might be thinking this sounds like conspiracy theory nonsense, like someone yelling about the sky falling. I understand that skepticism, and it's actually healthy. But let me show you why this isn't speculation. It's pattern recognition. In the past 15 years, we've watched governments worldwide implement precisely these types of changes when facing budget crises. Ireland raided private pensions in 2011. Poland seized half of its citizens' pension assets in 2013. Argentina has nationalized private retirement accounts multiple times. Portugal, France, and Hungary have all implemented policies that converted private retirement savings into government bonds with lower returns. And these weren't socialist dictatorships. These were functioning democracies that decided, when push came to shove, that accessible retirement savings represented the path of least political resistance. The United States has $34 trillion in national debt and growing. Social Security faces a funding shortfall that will require either massive benefit cuts or massive tax increases within the next decade. Medicare costs spiral upward as baby boomers age and medical technology becomes simultaneously more effective and more expensive. State and local pension systems remain underfunded by an estimated $1.3 trillion. This isn't a problem that can be solved by cutting wasteful spending or growing the economy, because the mathematics simply doesn't work. The bill comes due, and there's only one place with enough money to pay it. Your retirement accounts, collectively holding over $35 trillion, become the most obvious target. Let's pause here for a moment, Because if this information is making you anxious or angry, that means you're paying attention. And if you're paying attention, I need you to do something right now that will help both of us. Hit that like button because it tells YouTube that this information matters and helps us reach more people who need to hear it. Drop a comment below telling me where you are in your financial journey, whether you're just starting out or approaching retirement, because your perspective helps build this community. And subscribe to Easy Finance, because over the next few months, we'll be breaking down exactly how to navigate these changes with specific, actionable strategies you can implement immediately. The people who take action early will be fine. The people who wait will lose everything. Don't be in that second group. Now let me show you what the actual transformation looks like on the ground level, because understanding the mechanism matters as much as understanding the outcome. The changes don't arrive with dramatic announcements or obvious raids on your bank account. They come through boring legislative language that most people never read, implemented by bureaucrats who genuinely believe they're doing the right thing. The policymakers who vote for these changes don't see themselves as villains stealing your retirement. They see a funding crisis that demands solutions, and retirement accounts represent the most accessible pool of capital available. But here's where it gets truly insidious. The changes happen in stages, each one individually small enough to avoid massive public outcry. Year 1, they adjust contribution limits slightly downward. Year 2, they modify tax treatment on withdrawals. Year 3, they introduce new distribution requirements. Each step seems reasonable in isolation, but together they compound into devastating impact. It's like gaining 1 pound per month. Any single month, the change seems trivial. But look back after 3 years, and you've gained 36 pounds without ever having a moment where you said, "This is the month everything changed." The digital currency component accelerates this process in ways most people completely miss. When central banks launch digital currencies, which every major economy plans to do by 2027, they gain unprecedented visibility into every financial transaction. This transparency serves legitimate purposes like reducing money laundering and making tax collection more efficient. But it also means that governments know, in real time, exactly how much money you have, where it's located, and how you're using it. This information creates irresistible temptation for policy makers facing budget crises. They don't need to guess about revenue potential from new taxes. They can see the exact amount sitting in accounts across the country, calculate precisely how much they could extract, and model the political consequences before implementation. Think about how this changes the game completely. In the past, hiding money offshore or using cash transactions provided some degree of privacy and protection. Those escape hatches are closing rapidly. Every transaction tracked, every asset visible, every financial move potentially subject to immediate taxation or restriction. This isn't science fiction dystopia. This is the logical endpoint of technology meeting policy needs, and it arrives fully operational in 2027. So what do you actually do about this? Because understanding the problem without having solutions just creates paralysis, and paralysis guarantees you'll be a victim of these changes rather than someone who navigates them successfully. The strategy has 3 core components that work together to create financial resilience regardless of what policy changes emerge. First, diversify not just your investments, but your entire financial structure. This means holding assets in different types of accounts with different tax treatments. Traditional retirement accounts, Roth accounts, taxable brokerage accounts, health savings accounts, and even properly structured life insurance all get taxed differently and face different regulatory constraints. When rules change, they rarely change uniformly across all account types. Second, develop what I call strategic geographic optionality. This doesn't necessarily mean moving to another country, though that remains an option for some people. It means creating the ability to work remotely, considering what states or countries might offer better policy environments, and building skills that remain valuable regardless of location. The person locked into a specific physical location by job or family has fewer options than the person who can pick up and move with relative ease. Even if you never exercise that option, having it changes your negotiating position with policy entirely. Third, and this is the most important one that nobody talks about, invest heavily in developing multiple income streams and continuously expanding your skill set. The person who can only do one thing, no matter how well they do it, becomes extraordinarily vulnerable in an era of rapid change. The person who can do 4 or 5 things moderately well and who demonstrates the ability to learn new skills quickly possesses a form of wealth that cannot be taxed away, regulated out of existence, or devalued by policy changes. Your earning capacity, your adaptability, your network, these assets matter more in the world of 2027 than any specific investment strategy. Here's something that will surprise you. The wealthy have known these principles forever, which is why they rarely get caught flat-footed by policy changes the way middle-class families do. Rich people don't keep all their money in one country or one currency or one asset class. They don't rely on a single income source. They maintain optionality at every level of their financial life. The difference is that these strategies used to require expensive lawyers, accountants, and financial advisors that only the wealthy could afford. But technology has democratized access to these tools. The information you need is available, often for free. The platforms that enable geographic flexibility exist. The educational resources that let you develop new skills are accessible to anyone with internet connection and discipline. The gap between people who thrive in 2027 and people who suffer isn't about starting wealth or connections or luck. It's about information and action. The person who understands what's coming and adapts their strategy accordingly will be fine. The person who ignores the warning signs and continues operating on autopilot will wake up in 5 years wondering what happened to their financial security. Lisa Chen's story doesn't have to end in disappointment. Imagine an alternative version where Lisa, back in 2025, stumbles across information about coming policy changes. She spends one weekend educating herself, another weekend meeting with a fee-only financial advisor who helps her restructure her accounts, and then consistently implements small changes over 18 months. She converts a portion of her traditional 401k to a Roth account, accepting the tax hit now to avoid larger taxes later. She develops a consulting side business that generates additional income streams and gives her flexibility. She builds skills in her field that make her valuable as a remote contractor. When 2027 arrives and the rules change, Lisa experiences minor inconvenience rather than catastrophic loss. Her retirement remains on track because she saw the storm coming and built a stronger house. That can be your story instead of a cautionary tale, but only if you make the decision right now, while you still have time, to take this seriously and take action. And here's how you take the first step. Subscribe to Easy Finance right now, because this channel exists specifically to help people like you navigate the financial transformation that's already underway. We're building a community of informed, action-oriented people who refuse to be victims of policy changes they didn't see coming. Hit that notification bell so you never miss an update, because the strategies we share in coming videos could literally save your retirement. Share this video with anyone you care about who needs this information, because the people in your life who aren't paying attention to these trends are walking toward a financial cliff. And comment below right now with the single biggest financial concern you have about the future. I read every comment, and your questions directly influence what content we create next. The calendar doesn't stop. The policy changes don't pause because you're not ready. The world of 2027 arrives whether you've prepared or not. But you're here, you've watched this far, which means you're already ahead of 95% of people who will get blindsided by these changes. The question isn't whether you can survive the financial transformation coming in 2027. The question is whether you'll thrive because you saw it coming and adapted, or struggle because you waited too long to take it seriously. Your money will play by new rules in 18 months. Make sure you know what those rules are before it's too late. I'll see you in the next video, where we break down the specific account restructuring strategies that work best for different age groups and income levels. Until then, stay informed, stay adaptable, and remember that knowledge without action is just entertainment. Don't let this be entertainment. Let it be the moment you decided to take control of your financial future before someone else did it for you.